Good afternoon and welcome to FBN Charting Points, a technical look at ag markets. My name is Brian Como. Today is October the 11th, 2023. All right, we're going to get into first our disclaimer. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties express or implied as to the accuracy or completeness of the statements or any of the information contained in the material, and any liability is therefore expressly disclaimed. Past results are not necessarily indicative of future results. All right, first thing I want to do is go through some of the trade estimates for the USDA, which is landing in our inboxes or on the interwebs tomorrow at 11 o'clock Central Time, 10 o'clock Mountain Time. What we are expecting to see is a small reduction in corn production to 15.1 billion bushels, with the yield expected to drop by 0.3 bushels per acre to 173.5. The market is also expecting a small drop in soybean production at 4.13 billion bushels on a 0.2 bushel per acre yield drop to 49.9. So as you can see, there is a pretty wide range in estimates here. However, I don't think that there is necessarily a major whisper number happening here. I think that the market is, these are the numbers that I feel that the market is expecting. So if we do see something outside of what these numbers are, we may see some volatility tomorrow, particularly in the corn and soybean markets. Here's the grain ending stocks. It looks like the average trade is expecting wheat ending stocks to grow to about 647 million bushels in the U.S. Again, that's off of the production increases that we saw in the small grains report. They are expecting the corn ending stocks to fall by 2.1 or to 2.1 billion bushels, 2.138 to be exact, from 2.22. This is still a very burdensome carryout, still very large carryout, but it is a reduction. I think there is a risk here in the corn market in that I don't think the market is necessarily factoring in any loss of demand if the USDA is going to price some of that into the S&D. It's not a guarantee, of course, but it is possible. Soybeans, they are expecting, based on the increase in or decrease in demand, for the ending stocks to rise to 233 for the 2023-24 crop year. So this is what is expected. So again, I think if there is, there's pretty tight carryouts here in the bean market particularly. So if we see something outside of these numbers, either above or below those numbers, we could see some volatility in soybeans. And again, the question here is whether the USDA is going to strip some demand out of corn or if they're going to leave it unchanged for this reporting period. Here's the world grain ending stocks. Some small changes here, a small drop in wheat ending stocks down to 258.4 roughly, and an increase in soy on the back of South American production to 119.7. Again, that is using the South American crop that is just starting its growing or planting season at this point, which is expected to be record large in Brazil. Corn is expected to drop to 313,000, again on some changes to particularly South American growing conditions on the drier side in some areas. So, and a reduction in acres. So I think South America will be an important part of the equation here in tomorrow's USDA report. All right, let's get into some of what is going on in the markets today. So I'm going to start with oats. And the only reason I'm starting with oats is because for some reason, Twitter today decided to light up with the term oats knows and is getting everybody scared. And it's creating quite the discussion or the discourse on Twitter about those who think that statement is ridiculous and those who support that statement. I'm just going to tell you what I think the chart shows. What this chart shows is a bearish outlook for oats based on the technical outlook. Now, in the past 2 days, we've seen it break below support of just below $4.20 a bushel. We have that would be this support right here. We have this 20-day moving average moving very aggressively lower. This is the 200-day moving average cross here. It is about to cross the 100-day moving average. The momentum on this downward move is strengthening, and therefore, based on what we see in this chart, I would continue to look at this as a bearish oat chart, independent of all the other commodities. So I don't necessarily subscribe to the oats nose, but there definitely is something going on in oats. I do believe this is probably fundamentally driven, and what I mean by that is that the market had been pricing in smaller supplies, both in Canada and in the US. And I believe that either production is better than anticipated or much larger than anticipated, probably on both sides of the border, or else we're seeing a slowdown in demand. Both of those things might actually be true. And I think what we are seeing here is the fundamentals play out in the futures market, and that at this point continues to look bearish. So I wouldn't put any hope into this market as of this point right now. Soybeans are also looking relatively bearish here. As you can see, the momentum on the 20-day is continuing to accelerate lower. It has crossed all of the major moving averages now, and we now have a breach of support here. There was a slight breach yesterday, but recovered quite nicely. But then it broke down below that again today and closed below the 12-ish 60 or 1258 mark. This is a bearish looking November chart. The November, it still does hold the most open interest, so I believe it is the most actively traded and most influential at this point. So I did want to talk about that. I don't think the soybean story, the bearish soybean story, is over as of yet. Now I have some charts here talking about Brazil's exports, but what I'm going to do, I'm just going to close off my presentation here, and I'm going to show you a dashboard here that I have available to me for Brazilian exports. So this is what is hampering significantly the soybean market at this time, is what we're seeing out of the soybean or the Brazilian soybean export program. So I want to turn your attention here to this graph here, monthly soybean exports. This is what's already sailed for the month of October. We're at the 11th day here, and it's probably not even the 11th day as far as reporting goes. But if you look back, as we move into the end of the calendar year, we tend to see exports drop off quite considerably. You know, we are already getting close to areas where we are normally for the entirety of the October month. So here's October 2022 and October 2020, October 2021. So we're almost at the level of exports already, or Brazil's almost at the level of exports already that we would normally see out of Brazil at this time of the year. This orange bar here is what is scheduled to leave at this time. So there's a big shipment of soybean exports expected here for the month of October, and that's putting a lot of pressure into the soybean markets. This chart right below here shows the accumulated Brazil soybean exports for the year. And as you can see, it is far and above the last 5 years of exports. Here's what that looks like from a seasonal standpoint, where as we moved through May, June, and July, we saw unseasonably high soybean exports going through the calendar year. So this is putting immense pressure onto the soybean market. And as you can see here, all these yellow bars up here, this is the exports by destination of Brazilian soybeans. All these yellow ones are China. So China is gobbling up a lot of Brazilian soybeans at this time. All right, I'm going to go back to the slideshow here. Oh, it looks like they make me start over. How unfair of them to do that. All right, let's get through these here. Going to turn our attention now to January canola. I'm kind of looking at both months here, still January, still November. The open interest hasn't completely shifted yet from the November to the January, but it's getting pretty close. And there's more open interest now in the January than there is in the November. But I'll show both anyway, because I think that they both tell some stories here. So this is one area of test that we've been talking about for a long time. This is that 61.8% Fibonacci retracement. This is a common area for markets in a bullish or bearish, depending on which direction you're calculating it off of. But in this case, it was a bullish market from May here all the way up into mid-July. And it is now corrected to the 61.8% mark, which is a pretty standard correction in a major bullish market move. In some cases, we see the market turn here and move back up. But if we do see a break of this level, that could mean that the bearish or the bullish story is over, and we're going to see, trade move back down into this level or into, what is often a more normal level. And as you can see here, that's actually around that $620 mark, which actually before the big run-ups that we've seen in 2020, 2021, those were normal prices. In fact, those were considered high prices at one point in time. So let's take a look at the November here. As you can see, we've already started to break down below that level. There is some support here at around 685. That would be kind of where the low was placed in here. There's also kind of some support here at 690, but there's still a lot of risk in this market in both the November and the January, and as a result, you want to be positioned properly into this market. Just to give you some context as what's happening, this is not necessarily a Canadian fundamental story. In fact, I think the Canadian fundamental story is tighter than what we're seeing on the global scale. This is the vegetable oils. This is landed in China data. And as you can see, the vegetable oil complex is just out of favor in all aspects. And even palm oil has recently taken a big spill as production has ramped up in Malaysia and Indonesia. And the stocks there have also been reported higher than expected. So we're just seeing kind of this wholesale move lower in the vegetable oil complex. Unfortunately, what that's doing is it's creating a bit of a correction in the canola board crush margins here in Canada. So we were seeing very healthy margins in this, 165. This is board crush margin, so it doesn't take into account basis levels or the basis levels at the coast or freight to the coast or anything like that. This is just basically a calculation of soybean oil, soybean meal, and this as those are the pricing signals for canola oil and canola meal, and then the seed, the canola seed as well. So that's your board crush margin. But it is shrinking here, and it's not unprofitable yet, at least by the calculations that I make using freight and basis levels. But it is declining. I think this area here, when we saw this move up in September, or even when we saw the spike here in August, I think this booked a lot of crush business. We did see the last COPA number at 97.7% capacity utilization, which is extremely high. Canada is crushing a lot of canola. I think that was booked in these two periods of time. In fact, what's happening now is probably booked in August. We may continue to see strong crush as what was booked in September is probably being pushed into November or even December. So I think we'll continue to see strong crush numbers out of Canada. But what is worrisome is that once we move past kind of that January phase, now that we've seen crush margins come down, the pace of business, new business being booked, and the crush pace may start to fall as we turn the calendar over into 2024. Another risk here is Euronext rapeseed. Again, I think this has a little bit to do with biofuels and the price of crude oil and those types of things. We are seeing a test of support here of 430 today on the February Euronext. If it breaks below that, I think there could be some further downside here. So I do think that there is more of a correlation to rapeseed in Europe to the energy sector than there would be in Canada. But still, there are some pricing signals taken from these markets, these overseas markets, including what's happening in China and Europe and whatnot, that does affect our canola price here in Canada. All right, let's move into somewhat more positive news. Here's Chicago wheat, bounced off of lows at the end of, or made new lows at the end of September after the small grains report and the rise in production. Chicago wheat was positioned relatively short and rallied. It did fail to produce a new high above the 20-day moving average, which is a bit of a concern, and it's starting to move lower now, kind of taking some of the risk premium out from the Middle East war and that kind of thing. We're going to have to watch this area very closely. If it moves to a new low, that could give, as you can see, there's these number of stepped approaches here, And if it decides to move lower into that range, it could take another step lower, and that would be a concern for me. Of course, the major reason why wheat is having such issues is Russia. Russia is discounting their wheat right now, even though they say that they're not. But there are Russian wheat offers out for 12.5 protein at $229 right now, at least according to the sources that we use, which are relatively reliable. So the Russian harvest pressure and the size of the Russian crop, which they're calling 90 million tons of wheat this year, is continuing to put a lot of pressure on wheat markets. That is evidenced in the Kansas. We are seeing a hard test today of that support level from the end of September as well. If we see a break below that, that would be a bearish signal. Looking at the monthly continuous here as well, as you can see, that move in September did produce a new low, a very small new low, and it is starting to push down below that new low again. So from a monthly standpoint, if we break down below that level, we've got open opportunity to get back into that 550 to 575 area pretty easily, and that's probably not something that a lot of people are prepared for at this point. Minneapolis, again, is consolidating in this range. It is doing the same kind of thing as the hard red winter, except instead of having 3 steps, it took one giant leap down after the StatsCan report, or not StatsCan, the USDA report at the end of September. It's been trying to claw back since then. Again, this support at about 708 is what we want to watch. Looking at that from a monthly standpoint, that would be where this support line is. So if it starts to break down below this support line, I think further weakness is in the cards here. All right, I want to leave you with the positive one. This is corn, December corn. I actually kind of like this chart, and I think it has a couple of good things going for it. It's not overly bullish, but one of the things I'm looking at here is kind of this convergence of moving averages. That kind of signals a more neutral tone to the market, at least at this point. And it has risen and started to produce some, lower or higher lows here, as you can see, and some higher highs. That's a nice sign. This is a nice new high here as well. And if this can bottom here before making a new low, and I'd be looking at this one, that would be a positive sign. It's starting to trade now above the 20-day the 20-day moving average, which is this one. And if it continues to trade above that, I think we could see some slow momentum above here. I think that $5 area is a psychological barrier, not necessarily so much a technical one, although there is a previous high here on that. But if we can start to move above that, I think that there is some opportunity to continue to grind this market higher. All right, that is all we had for you today. Thank you very much for joining us, and we will see you again next week. Have a good day.